Just 2 weeks ago I said that there were green shoots coming through in terms of European property, and the credit crunch had had its initial effect and property would probably move forward. I don't think the credit crunch has actually stopped in any way, and I think there's probably more bad news to come out financially and economically, probably with the States definitely going into recession and UK slowing down. But I think in terms of property, the initial effect, which was to move the markets, has been seen. And already in London we're seeing an increase in liquidity. In London the valuers and the market has moved in accordance with the downturn, and yields perhaps in central London have moved down by up to 100 points. Different markets are at different stages. I think that Spain probably is the next market to become liquid and see a price reduction, but I think that markets such as Germany and France are fairly static at the moment because the vendors haven't accepted that there's been a movement in pricing. Prime yields in the West End were probably down as low as 3.5%, and in the city perhaps 4.5%. Now a prime West End building, not that there's one available, would probably be 4.5% plus, and in the city at the moment you can buy good, well-let buildings on long leases for yields at 5.25%, 5.5%. There's been deals done in Warsaw and Prague recently at the same sort of yield. So London in terms of pricing looks very cheap. If you're buying at the same price in Central and Eastern Europe, I don't think that the risk premium's there. So London in terms of the borrowing rate, in terms of pricing in Central and Eastern Europe, looks pretty good value, and I would expect other major capital European cities to follow suit.